Okay, so we've described how consumers and firms behave in this model, and we're now in a position to actually do something with it. So what we will do is we will now determine what will happen to supply and demand for labor now and in the future. We'll determine the firm's investment decision, and then we will also determine how much production there will be today and in the future, and also how much consumption. Out of this will come two relative prices that get determined in the equilibrium. One is going to be the real wage, actually three relative prices, the real wage today, the real wage in the future, and then the intertemporal price, which is the real interest rate. Now, government behavior in this model is exactly as it was in the simple endowment version of the consumption savings model. Government today buys goods G, pays for them with revenues T, and any difference between spending and revenues it has to finance by borrowing. In the future period, then, the government has to pay off its debt. It has to raise enough taxes to cover government spending in the future, plus this paying off of the debt. So the present value constraint is just that the present value of purchases equals the present value of taxes. So as I said, what we're going to do is we're going to go into the labor market and look at supply and demand for labor, and that's going to give us the equilibrium wage and the equilibrium level of employment. That's for today. We could do something analogous for the future period as well. Then we're going to derive that the supply of goods depends on the real interest rate. The demand for goods is also going to depend on the real interest rate. Consumption, as we know already, and investment both depend on the real interest rate. So out of all of this is going to come two relative prices, the real interest rate and the wage, as I said, also the wage in the future, and then the quantities, consumption today, investment, employment today, the capital stock, actually this should be probably in the future, and output. Okay, so we're going to focus now just on labor and goods markets in the present period, current period. And what we want to ask is what happens to equilibrium prices and quantities if exogenous stuff changes? And the exogenous things we'll focus on will be changes in either current or future government purchases and changes in current or future total factor productivity. We're headed toward trying to get supply and demand for goods as a function of the real interest rate, so that what we'll have down here might be output today, the real interest rate today, and then we will have some output supply function and some output demand function. We're now going to get an upward sloping supply function when we had an endowment. Remember that the supply of goods was just perfectly inelastic. So it didn't matter what the real interest rate was. That didn't affect the quantity of goods available. So what we're going to do is, as we always do when we derive supply and demand curves, we vary some relative price. In this case, it's going to be the real interest rate. And then we just trace out how quantity supplied and demanded changes with that price. So we have that output day is just equal to, we've got a production function. So remember, we're inheriting this capital from the past. There will be some equilibrium level of employment that's determined by supply and demand in the labor market. So these inputs get combined with total factor productivity to give us the quantity of goods that are available today. Now, because we inherit capital from the past and total factor productivity is exogenous, once we know employment, we know what output's going to be. So let's go to the labor market. We've already showed that a higher real interest rate increases the relative cost of leisure today, and therefore induces people to substitute out of leisure and into supplying labor. So a higher real interest rate is going to increase the quantity of labor supplied. We also know that labor demand is just given by the marginal product of labor, and this doesn't get influenced by the real interest rate. So changes in the real interest rate will show up through changes in supply, but not generate any shifts in demand. Let's imagine that the economy is initially in equilibrium at point A, where we have a real interest rate of R1 and an equilibrium wage of W1 and N1. We're originally in equilibrium at this point A with a wage of W1 and a level of employment N1. Given that level of employment N1, using the production function, we see that we're producing a quantity of goods Y1. So remember that this point A is associated with the interest rate R1. So then that gives us 1 point on the supply curve for goods today. That's point A, where we have the interest rate of R1 and the level of output Y1. Now, of course, what we're going to do is we're going to raise the interest rate to R2. Now, we know that that's going to increase the relative price of leisure today. Consumers are going to want to work more, so that's going to cause the labor supply curve to shift out. This is going to drive down the wage. If the wage falls and firms want to equate the marginal product of labor to the wage, they're going to increase the quantity of labor demanded, because that then will drive down the marginal product of labor to keep it equal to the wage. This will give us a new equilibrium point in the labor market, which would be point B. So we have the labor supply curve shifting out. Remember, what's happening here is the real interest rate goes up. So that means for any given wage, consumers now want to supply more labor. And firms are willing to slide down this demand curve because the wage is falling, and so they want to increase the quantity of labor that they employ in order to drive down the marginal product of labor to keep it equal to the wage. Then we get a higher level of employment. Go to the production function, we get a higher level of output, Y2. So now we have a second point on this output supply curve. A higher real interest rate is associated with a higher quantity of goods supplied because workers are supplying more labor. Firms are willing to hire that additional labor and use it to produce more goods. So what we get is that the supply curve for goods today is upward sloping when the relative price that we're looking at is the real interest rate.